Over the past 6 months, Japan tried everything to save the yen. In January, the yen surged 4.3% against the dollar in 10 days. It didn't last. In April, Japan intervened again, spending $73 billion, but the yen kept depreciating anyway. Then the Bank of Japan hiked interest rates to a 31-year high. However, that didn't work either. So what is causing the yen to collapse right now? It all begins with Japan's government debt exceeding 200% of GDP, which is a level that puts it in a category of its own among other major economies. The United States, by comparison, has already surpassed 125% of GDP, while the euro area and China are sitting closer to 85%. In other words, Japan is carrying roughly double the debt burden of the US and more than twice that of the euro area and China, when measured relative to the size of its economy. The explanation for this lies in a combination of deficit spending and low interest rates. For most of the past 2 decades, Japan's borrowing costs have been near 0%, which meant that running large deficits came at almost no real cost. The government could simply roll over the debt by issuing new bonds to cover the bonds that matured. The implication of this is straightforward but severe, because a debt pile this size only stays manageable as long as borrowing stays cheap. For nearly 2 decades, Japan could count on exactly that. But then, in 2024, something changed. In March of 2024, the Bank of Japan abandoned yield curve control. Before, the Bank of Japan used to purchase government bonds in order to keep long-term bond yields close to 0%. This way, it was easier for the government to roll over the accumulated debt. At the same time, though, this caused the yen to weaken significantly, as the Bank of Japan was printing newly created yen in order to keep the rates this artificially low. Coinciding to this, rate hikes in the US led the US Treasury market to attract more capital, which weakened the yen further. And so this is why the Bank of Japan was now ultimately forced to abandon yield curve control. But now, for the first time in a generation, Japan's borrowing costs were free to rise on their own. The 10-year Japanese government bond yield climbed from 0.7% in 2024 to more than 2.6% in 2026, recently touching levels not seen since 1996. The rise in bond yields can be explained by the market starting to price in risk that used to be invisible when the Bank of Japan kept yields artificially low. But now, after yield curve control ended, investors demand higher yields not only because of Japan's extremely high level of government debt, but also because of rising inflation. Inflation is currently rising as Japan is absolutely dependent on importing energy from abroad, with a big share of oil and gas being imported from the Gulf region. As the war is still causing big supply disruptions, energy prices, especially the Asian benchmark for the price of natural gas, the JKM, have been rising significantly over the last few months, pushing inflation higher. So what do you think happens next with the Strait of Hormuz? Let us know in the comments below. Now this is where it gets interesting, because rising bond yields come with severe consequences. Every percentage point that bond yields rise translates directly into rising expenses for the Japanese government in the form of higher interest payments on the trillions of dollars in debt. This is not visible yet because the bonds issued under low rates first have to mature. But from that point on, the debt has to be refinanced by issuing bonds with higher interest rates, which then causes interest payments to rise. This chart explains why interest payments don't rise immediately, but with a bit of a time lag. It shows the outstanding bonds by remaining years to maturity, specifically highlighting how much money the government must refinance within different time horizons. As you can see, Japan's government debt is heavily concentrated in long-dated maturities, with over 58% locked into 10 to 40-year terms. However, a significant 17.4% portion of the debt portfolio, totaling over 207 trillion yen, matures in under 1 year and requires immediate refinancing. As bond yields are currently surging, the massive block of long-term debt shields the government from immediate pain because existing bonds keep their low rates fixed until they mature. However, the short-term debt block must be reissued immediately at today's higher interest rates. And history shows that rising interest rates are dangerous for another reason, because when interest rates rose back in the 1990s, that ultimately led to a big stock market crash where the Nikkei declined by more than 50% over the next 2 years. Today we can see the exact same pattern. The Nikkei has been surging over the last few years while the Bank of Japan started to hike rates, potentially causing yet another stock market crash. And so this is exactly the dilemma that Japan is currently facing. They tried to fight rising inflation and the massive devaluation of the yen by increasing interest rates and by stopping yield curve control, but the yen still weakened against the dollar, while they are now also threatened by a debt problem and potentially yet another stock market crash. Rising interest on maturing bonds can only be paid by issuing more bonds, and this is problematic because when the supply side of bonds rises, the demand has to rise in a similar fashion in order to sustain the same yield. But with a rising debt pile, it will get increasingly harder to sustain demand, which again pushes yields higher. As you can see, this is a self-reinforcing spiral. And history shows that the way this spiral typically ended was through a deflationary stock market crash, which then gave the Bank of Japan justification to print money, devalue the yen, keep yields artificially low, and continue this process of rolling over debt again and again. So if you have any further questions, don't hesitate to ask them in the comment section below. And if you found this analysis valuable, please subscribe to our channel and hit the like button as it helps us reach more people who need to understand what is currently happening. Thank you for your time.